Hey guys, in today's video, I want to take you through a bit of a crash course into how we use the Fibonacci extension levels. So in particular, we're going to be focusing on the 161.8 level and the 127.2 level. For those of you that have been watching this channel for a while, you'll already be fully aware that the Fibonacci extension levels make up some of the tools that we use in the Duomo method. And for those of you that have obviously taken our course, you'll know all about it. The link's in the description box if you want to know more about that. So, there are some fundamental ways that the way that we approach the Fibonacci analysis is different to how other people do it. You may have seen our videos already about the retracement levels and why we don't trade them and how we actually use them to make our analysis more accurate. If you haven't seen those videos yet, then I really recommend you watch them first. Understanding what we talk about there is a prerequisite to this one. I'm not going to go through the same things in this one, so I recommend checking those out first. The links are in the description box, and then this will make a lot more sense to you about what you do now. But for those of you that watch those videos, you may have been wondering, okay, so I understand you use the retracement levels to confirm the range, but then how do you actually trade based on Fibonacci then, once you've confirmed the range? Well, the answer is that we use the Fibonacci extension levels. There are all kinds of reasons and rules about how we do certain things and when we don't use the extension levels and when we do use them. So I'm not going to be going through everything in this video because it will take a hell of a long time. But in this video, I just want to go through, like I said, a crash course to talk you through how we actually map them out on the charts and what we're looking for, and a few rules about when we can use them. And in terms of the way that we do our analysis with Fibonacci and how that differs to how other people do it, I mean, there are all kinds of rules about situations that we do use it in and don't use it in, but I think fundamentally there are two things we're looking for here. One is confirming the range. I don't see anyone else confirming the range with the type 1 and type 2 closes. And the second thing is actually using the type 1 and type 2 closes for entering based on the extension levels, because obviously the type 1, 2, 3 closes are something that's fundamentally something that's part of the Duomo method, and you don't usually see it elsewhere. It's usually other things that people use for their entry setups and so on. But anyway, what we're going to do is jump into the charts, and I'm just going to explain with a few examples how we go about doing this, and then at some point in the future we'll jump into the theory side and explain why this works in the way it does, why we've got certain rules about when we do and don't trade it this way, and so on. So let's go into it. So I've chosen Euro Japanese Yen because this has been one of my favorite markets over the past, well, this week, especially on the intraday timeframes, but for the past few months it's been great for ranging markets. But this sort of move down that we've had here today on this hourly chart has been nice and structured. And when you have a structured market, that's a good time to use the Fibonacci extension levels. So when we look at the extension levels, we're effectively saying that we have our A to B point like this, A, B. We've confirmed the range of our C point, like we spoke about in that Fibonacci retracements video. And so then if we're going to be trading the extension levels, we're essentially saying that the price is going to be breaking out of that wave, breaking out of that range there. And therefore, that sort of dictates the times that you would use the Fibonacci extension levels. If price is sort of moving down in a structured way, if it's struggling to break at the bottom of each wave and then breaking through, you know that the chances are there are going to be extension levels that are going to be in play, especially if you've confirmed that C point. So then we're creating, at this point, we're creating what we'd call an A, B, C, D pattern. And the D part of that A, B, C, D pattern is going to be the extension levels, either the 127.2 or the 161.8. Now, when we look at the Fibonacci range, which I'm just going to draw out based on this one we just mapped here. Oh look, it actually confirms there as well. When we look at the range, then we've got A is 100, B is 0 on the Fibonacci. Your retracement is going to be either the 38.2, the 50, or the 61.8 like we spoke about in the retracements video, which means that since it's coming out down this side, it's going to show on your chart as minus 27.2 or minus 61.8. But I still refer to them as the 127.2 and the 161.8 like it would be at the top of the range. And really, it doesn't matter what way round you draw the range, the sort of distance between the different levels is exactly the same on both sides. But the correct way to do it, and I actually didn't mention this in one of the other videos and I got told off for it, which is why I'm mentioning it now. The correct way to do it is that you see here it's 38.2 of the way back into the range. Like if retracing all the way up here is to retrace 100% of the range, then at this point it's 38.2%, at this point it's 61.8%, which means obviously below the 0 you've got minus levels. So just a little bit of background there for you. Let's get rid of these arrows and get onto some actual examples. Now, hold on 1 second before we move on to the examples. Where we had this ABCD pattern, that obviously means that we need to be approaching the extension levels from one particular direction. So if we're in a downwards movement, we've had like a wave like this, A, B. We're looking at the C point up here, whichever one confirms the range. And that's what we have here. Now, if you were going to be looking at the extension levels, because obviously extension levels get created on both sides of this range, at the top and at the bottom, like I just showed you. If you're going to be trading the ones above, like up here, so you're going to be trading levels up here, that's no longer going to be an ABCD pattern. It's an AB, and this is just a C point still. We don't want this V shape basically happening. We want a nice zigzag shape like this. Kind of like a little Zorro type Z going on there in a way, like a sideways S. So always, we're approaching the extension levels from the direction of the range. So the direction the range is being created in, the retracement, whatever direction it comes to, we're then looking for a type 1 or a type 2 close on the extension levels to be able to trade them. And there are some other little rules that we're going to go through in a second. But if the price was coming up this way, then we would be essentially looking at what happens before this in that same direction. So we'd be looking at this leg up that happens here, and we'd be aiming to confirm this as an AB by looking at this retracement here instead. And if there is no retracement there, then we can't trade it. Just because, now basically the market's always moving in these waves. Just because we can't confirm the range with our C point doesn't mean it's not the correct range. It doesn't mean the market's not going to respect those levels, but it means that we can't have the certainty to be able to trade it. So these are the rules we stick to reduce the uncertainty, to get more dependable setups. It doesn't mean this is the only way to get waves in the market and to predict what's going to happen. It's the only way that we can do it safely in order to trade. I really hope that's clear enough that everyone understands that. There's, we can draw logical ranges in the market where the C point is not confirmed, but it looks like it's definitely going to be the right range, and it may well be the right range, and those extension levels may be amazing and reverse the price how you would expect them to. But we don't have that certainty without the range being confirmed. So those are the only ones we go for. So in a situation like this where the price is moving down, every time we get these sort of retracements and it comes back down to the B point, the bottom of the range, I'm starting to map these out to confirm that retracement, confirm the range. So obviously in this case, we'd go for up here the A, we'd have the B point down there, confirm the C there. I'm not going to try the different variations because it's just a demonstration. But you can see we start to break out the range. However, once we start to break down this way, you can start to see we have another retracement there. So although this range can still be in play, I always like to favor the more recent ones. Now you can see that the extension levels, we do actually get interactions. We get a type 2 close there. It doesn't do what we'd expect it to, which is fine. This is all about probabilities. And as well as that, that's why we go for a double confirmation, so we can have certainty that it's going to do what we expect it to, or at least less uncertainty that it won't. You can see down here we get the type 3 close and it goes up. So as we're moving along, we start to create this range along here. I'm only going to be mapping out the short movements. I'm not going to be mapping out the bullish movements, the long ones. So we have then also this. We have a confirmed range here. And in this case, we have extension levels at the minus 27.2 here. We get a type 3, doesn't do what we expect. And the minus 61.8 here. You can see the price breaks through. This one never got into play. Now, in this case, when we have the A, B, C, and it comes down here, once it breaks through like that, then these extension levels, like that range is dead for us. Although significant levels have no directional bias, these will still be significant from the other side as well, and you can see in some of these cases that it is. We only want to trade it as an ABCD pattern, so therefore we only ever want to trade the extension levels from the direction of the range. And this is the only significant level that we have that rule about. All other significant levels in the Duomo method we can use from either direction equally, but the extension levels, because we're looking for that specific pattern, we need to trade in the direction of the range. And the reason for that is that there's a big difference between a significant level just slowing down the price or creating some sort of consolidation or a small bounce, and actually having a movement that's tradable, something that's going to create us enough profit that it's actually worthwhile. And that usually happens when it's an ABCD and not so much if it's coming from the other direction. So anyway, at this point, obviously that wave's been created. We didn't get the interaction we wanted there, or we didn't get the reaction we wanted, but the price has moved on. We now can confirm here. So we're looking at what can confirm that point there. It's either going to be this or it's going to be up here. I think that's the best one we got there. A, B, C, the price moves through the minus 27.2, another type 3 at that minus 61.8. Now what you might have been noticing here is that we're getting a lot of the levels in the same area. And this is what we call confluence, and it's going to be, that's going to make us have a very dependable trade in that area if we do get one. So for example, we had that minus 61.8 down here. We had one along here. If we do that A, B, the C was confirmed. That gave us a minus 61.8. That was actually a little bit further up here, so it was not so good for us. And then if we move this one down to here where we had it confirmed before, we have one down here as well. In general, just by the nature of the levels, the 127.2 or the minus 27.2 is less dependable than the 161.8 because first of all, the 161.8 is further from the price. So obviously if the price is broken out of the range, it's going to be more oversold or the opposite, overbought once it gets to that level. Also, just by the way that the calculations are, the 161.8 is a lot stronger. The actual way it connects to the overall theory of why this works is stronger. It's the golden mean. The 1.618 is the golden mean after all. But that's something we won't go into a lot of detail in this video. It's something we'll cover later on. But in general, if you have a setup that's a weak setup with a 127.2 or a minus 27.2, then I'm going to favor that a lot less. If it's with the 161.8, perfect. That's one of the most dependable levels we can have. The 127.2, not so much. So let's move on. We can also see here that there's another sort of retracement that we can try and confirm that one. I don't think we're going to be able to, just looking at how it is. It's maybe going to be a tiny one. It's confirmed, but the levels aren't in play for us. So you can see once we get down here, we get those type 3 closes. Let's get rid of these and move on. So if you had a double confirmation round there, you know where the path of resistance is, things get a lot more dependable for us. Now you can see these smaller ranges that are happening along here. I believe these should also be able to confirm. It doesn't matter about the size so much. The bigger the movements, the more dependable it is. But you can see here, A, B, the C is confirmed here. Price breaks out, fails at that minus 61.8, comes back up, the same as it was at the 161.8 of the previous ranges we were looking at. At the same time as that one, we also have this range down here, another small one. And you can see that this one is also confirmed here. The minus 161.8, sorry, the minus 61.8, the 161.8 there. This is close with a tiny bit of tolerance to being a type 2, but we'll still count it as a type 3, and you can see the reaction that we get there. So basically, like, I know these are not maybe the most amazing examples in the world, and we had a couple of things on the minus 27.2 where it didn't do what we expected, and obviously there was type 3 closes rather than type 1 and type 2. But I just wanted to demonstrate how we do this in the market, because once you see in our Sunday technical analysis, when I'm doing it in the live situations there, you can see how often these setups happen, how dependable they are. And if you go and spend some time practicing in the markets for yourself, then you'll also notice it. There are, like I said, a lot of rules about times we do use the levels, times we don't. Other things we need to keep in mind, the fact that significant levels attract and repel the price. So if there are significant levels, key significant levels below one of these extension levels, it may be that it gets pulled through there. And there are also other characteristics about how the price interacts with certain areas, how it can move very sharply through certain levels and so on, which give us more clues about how these ranges work. But this is just a crash course so you understand what you're doing, and we'll maybe get into a lot more detail at another point in time. And make sure you check out the Sunday technical analysis videos so you see this in action, and you'll see a lot more sort of dependable and very clear examples then over time. But guys, that's all for now. If you want to know more about our method of trading, if this is sort of piqued your interest a little bit, then check out the link to our Inner Circle mailing list in the description box of this video. It's free to join, and that way you get access to our 4-part video mini-series to start learning some of the foundations of our approach of trading. Don't forget to subscribe to the channel for more lessons about trading, the financial markets, and so on. There's a lot of different videos we have on this channel. If you are new to the channel, then go and have a little browse. Leave a thumbs up if you like this video, and leave any comments and questions below. I appreciate you watching, take care, and I will see you soon.